Imagine waking up on the first of the month, checking your brokerage account, and seeing a crisp deposit for $1,000. No alarm clock, no commute, not from a salary, not a side hustle. It is a dividend. A dividend is a regular payment made by a corporation to its shareholders out of its profits. Companies pay you simply for owning a small piece of them. You see this exact scenario plastered all over the internet. Financial influencers constantly post screenshots of their payment histories and show off colorful passive income dashboards. The appeal is incredibly strong. Your money works for you, generating cash automatically while you sleep, travel, or go about your day. But those viral posts leave out a crucial piece of the equation. The actual amount of money you need to have invested to generate that $1,000 a month is massive. When beginners finally sit down and look at the real capital required to hit that goal, the entire strategy can suddenly feel like an impossible dream. The popular narrative online sells a frictionless lifestyle, masking the heavy mathematical lifting required to actually build that income stream. To see what that math really looks like, we start with a standard baseline, a 3% dividend yield. This financial ratio shows how much a company pays out in dividends each year relative to its stock price. Investing a $100 base block produces a tiny offshoot of $3 per year. To get $1,000 a month, we need $12,000 a year. To support that payout, the initial investment must scale up to $400,000. $400,000 is the actual price tag attached to the $1,000 a month dream at standard market rates. Even then, that $12,000 figure is just a gross amount. It is the number before the government takes its cut. This diagram illustrates the impact of taxes. Depending on where you live, the type of brokerage account you use, and your personal income tax bracket, a distinct wedge is sliced off your dividend payments. Because you only keep what is left over, the true amount of capital needed to take home a net $1,000 a month is noticeably higher than $400,000. Face to face with that massive target, a common reaction is to look for a shortcut. Investors often hunt for assets paying much higher yields to shrink the capital requirement. As this animation shows, an abnormally high yield usually signals danger. Unusually high payouts directly correlate with a severe risk of capital depreciation, turning those shortcuts into expensive mistakes. Attempting to bypass the mathematical reality by ignoring taxes or chasing risky, oversized payouts will ultimately sabotage the health of your entire portfolio. You can figure out your own personalized capital target right now, and it only takes about 10 seconds. This formula shows exactly how to do it. You take your desired monthly income, multiply it by 12 to get your annual goal, and divide that by your target yield. When you hit equals, the resulting number might be shockingly large. The instinct is to close the calculator app and give up entirely, but that is the wrong move. Instead of viewing that massive figure as a deterrent, recognize it for what it actually is, a concrete, mathematically sound target. Once you establish a real number based on hard data, you can stop guessing. You now have the exact blueprint needed to build an actionable plan. This highlights the primary misunderstanding of dividend investing, expecting a small portfolio to replace a full-time paycheck overnight. Building a sustainable income stream requires a multi-year commitment to consistent contributions and a refusal to chase high-risk yield traps. Real passive income grows predictably over decades. Now that the timeline is clear, we can look at how these dividends operate behind the scenes. Imagine waking up on the first of the month, reaching over to the nightstand, and seeing a $1,000 deposit hit your account. No alarm clock, no boss. That money did not come from your job or a side hustle. It came from dividends. Companies paid you cash simply for owning a small piece of them. You see this lifestyle all over the internet. People showing off passive income dashboards and posting screenshots of portfolios that pay them every single month without lifting a finger. Getting paid automatically is entirely possible, but the people posting those screenshots almost never show the massive amount of money they actually need invested to generate that cash. The reality is that generating a meaningful monthly income through dividends requires a significantly larger initial investment than most people expect. When someone new to investing finally does the math and sees the real number for the first time, it can be a massive shock. Suddenly, the idea of an extra $1,000 a month feels like it was too good to be true, or like the whole concept of passive income is a deceptive trick. To actually build wealth this way, you have to let go of the internet fantasy, sit down with a calculator, and look closely at the cold, hard math. A 3% yield is a standard conservative benchmark to estimate dividend income. For every $100 invested, you collect exactly $3. But here is a crucial detail. That 3% return is generated over an entire year, not every month. This means to collect $1,000 a month, you need $12,000 a year in dividends. To hit that $12,000 annual target at a 3% yield, you need exactly $400,000 invested. The capital required absolutely dwarfs the payout. Accepting this heavy ratio of capital to income is the mandatory foundation for building a realistic passive income strategy. And the math gets harder. That $12,000 a year is a gross number, meaning it is the amount generated before taxes. Depending on where you live, the type of brokerage account, and your personal tax bracket, the actual amount you keep will be reduced. You might need even more invested to clear $1,000 net. Once you see that $400,000 requirement, your immediate instinct might be to look for investments paying higher yields, maybe 6 or 8%, to shrink the total capital you need. Chasing those numbers is highly dangerous. Abnormally high yields directly correlate with unusually high financial risk. Seeking out risky, high-yield traps as a shortcut to beat the math is a very fast way to destroy your capital instead of growing it. So right now, take 10 seconds to calculate the exact capital requirement for your own specific income goal. This formula shows exactly how to find your target. Take the monthly dividend income you want, multiply that by 12, and then divide the total by your target yield percentage. Write that final result down. This number is no longer a guess, but a concrete mathematical baseline for your portfolio. That number might look impossibly large right now. Do not let it discourage you. Realizing the scale of the climb is the mandatory first step to building a legitimate, actionable plan. Dividend investing is a slow, multi-year wealth accumulation process. It is not an overnight trick for a quick paycheck. The investors who successfully build meaningful income share a few common traits. They understand the math early. They avoid dangerous yield traps and consistently invest month after month. This graph shows how real results manifest. The compounding effects work predictably and powerfully over decades, rather than months. In the next parts of this series, we will break down exactly how dividends work mechanically behind the scenes, outline the most expensive mistakes beginners make, and detail a step-by-step strategy to scale your portfolio. Whether you are starting with $500 or $50,000, you now have the proper mathematical framework to begin the journey. Earning $1,000 a month in dividends is a common target. To hit it, you need significantly more capital invested than you might assume. Before you even think about building a portfolio, we need to strip away the assumptions and look at the physical realities of where this money comes from. Once you understand the mechanics, every investment decision gets clearer. A dividend is a cash payment made by a company directly to its shareholders. That cash is pulled straight from the company's actual profits or its free cash flow. This diagram shows the cash flow of a young, rapidly growing company. Notice how the profits route in a closed loop straight back into the core business. They reinvest every spare dollar to fuel their expansion, leaving nothing left over to pay out. More established businesses operate differently. As the diagram expands, you can see the profit flow split. The company still sends a portion back into the business, but the leftover earnings flow outward to you, the shareholder, as regular dividend payments. Recognizing where a company sits in its growth stage dictates your expectations. It tells you immediately whether that stock will act as a source of long-term capital growth or a reliable engine for cash income. The actual amount of cash you receive relies entirely on two simple variables: the exact number of shares you own and the cash amount the company agrees to pay for each of those shares. Investors measure this using dividend yield. Dividend yield is a simple metric calculated by dividing the company's annual payout by its current stock price. This mathematical visualization breaks down the baseline formula. If a single share of stock costs $50 and the company pays out $1 a year, the math outputs a yield of exactly 2%. Here is where beginners make an expensive mistake. They scan the market, see a stock with a much higher yield, and automatically assume it is the superior investment. The math hides a dangerous trap. Watch what happens when the $50 stock price drops by half to $25, while the payout stays at $1. The yield immediately jumps to 4%. That doubled yield does not mean the investment improved. The stock price fell by 50%, which is a loud warning sign that the underlying business is likely under severe financial pressure. If you buy a stock based solely on a high yield percentage without investigating the health of the underlying share price, you are guaranteeing a massive loss of your own capital. The true appeal of dividends reveals itself over a long timeline. It happens when you combine the cash you collect with the underlying growth of the investment itself. These trend lines show the difference. A flat value line offers high payouts that eventually stall and drop off. A rising value line offers modest, consistently increasing payouts. Investors track this using total return, a metric combining your total dividends with the overall change in stock price. As the rising value merges with the payouts, the cumulative area entirely dwarfs the stagnant high-yield chart. A portfolio built on a blend of reliable, modest payouts and steady price appreciation will consistently generate more wealth over the decades than a portfolio built by frantically chasing immediate, high-yield payouts. Total return is the ultimate measuring stick for dividend investors. It proves mathematically that the growth of your capital matters exactly as much as the income it generates. There is also a logistical reality to getting paid. Dividend checks do not automatically arrive on the first of the month like a salary. Companies set their own payment schedules. Some choose to pay quarterly, others pay twice a year, and a few only distribute cash once a year. This calendar grid demonstrates the solution. If you want income arriving every single month, you have to intentionally buy a mix of investments with non-overlapping payout dates, staggering them so exactly one payout lands in each month. Generating consistent monthly cash is a product of deliberate architectural planning and active staggering. It is not a default feature of the stock market. So let us summarize the mechanics. Dividends are real cash payments from real companies, but an isolated, high-yield number is a dangerous metric to trust blindly. Long-term stock price growth is an absolute requirement for a successful dividend strategy. And if you want that cash flow to hit your account reliably every single month, it takes deliberate scheduling. You now understand the underlying mechanics of how dividends work. The next vital step is learning how to sidestep the specific mistakes that routinely ruin beginner portfolios. There is an undeniable appeal to watching cash land in your brokerage account without you having to lift a finger. You buy a slice of a company and they send you a portion of their profits. But when people first start building a portfolio designed to generate this kind of income, they almost always stumble into a specific set of traps. These mistakes are dangerous precisely because they do not feel like mistakes. In the moment, every one of these decisions feels entirely logical and even protective. Yet beneath the surface, these intuitive choices are quietly draining your capital. They chip away at your returns so subtly that you might not even realize you are losing money until the damage is done. To actually survive and build wealth this way, you have to look past the immediate emotional reward of a payout and understand the mathematical reality operating underneath it. The first trap is the most common. You look at a list of stocks, you see one offering an 8 or 9% yield, and your brain automatically flags it as the obvious winner. But a yield is simply a percentage based on the stock's current price. When you see an unusually high number, it usually means the stock's price has recently dropped sharply. That kind of drop points to a company under severe financial pressure. And when a business is struggling to stay afloat, the very first thing management will do is cut or completely eliminate their dividend payments. You buy in expecting a massive payout, only to end up holding a depreciating asset that no longer pays the income that brought you there in the first place. This leads directly into the second trap. We get so hyper-focused on the cash arriving in our accounts that we completely ignore what the rest of our investments are doing. Look at this pie chart. It represents a theoretical 4% dividend payout. That income feels great. But as the underlying stock price falls by 6% over that same period, your account value still went backwards. The payout was entirely erased by the capital loss. What actually matters is your total return. Total return is a metric that combines the income you collect with the growth of your asset's price. Successful investing requires balancing both, rather than blindly chasing a yield. The third trap occurs when investors decide to put every single dollar they have into dividend-paying stocks. Reliable dividend payers cluster in specific, slower growth sectors: utilities, energy, and finance. Building your entire portfolio from just these creates a massive point of failure. If those sectors face economic headwinds, your entire account struggles at the exact same time. Plus, you miss out entirely on companies that reinvest their profits into expanding their business, rather than paying out cash. Many of the strongest long-term performers pay little to no dividend at all. Then there is the fourth trap, which is purely psychological. You start investing, collect your first few dollars, and immediately compare it to someone on social media showing off monthly dividend checks of several $1,000s. What those posts almost always leave out are the mechanics of how they got there. They either started with a massive lump sum of cash, or they have been quietly investing their money for 15 to 20 years. Comparing your first year to their 15th creates a sense of inadequacy. That frustration pushes new investors to abandon safe strategies and take on dangerous amounts of risk to catch up. Early dividends are small. That is the mathematical baseline. Accepting that slow, steady reality is the only way to keep out of the high-yield trap. This graph shows what triggers the fifth trap. The market dips, and investors panic, selling off their holdings because they are terrified of losing their dividend income. While daily stock prices bounce around constantly, dividends from financially healthy companies operate on a completely different track. They can remain remarkably stable, even when the broader market is falling. Selling during a downturn does not protect your income. It locks in a permanent capital loss, and it completely breaks your portfolio's compounding engine. Compounding is the process where your investment earnings generate even more earnings over time. In most cases, that daily price movement was just noise, and the income would have kept flowing if you had just held on. Every single one of these 5 mistakes stems from the exact same root cause. They happen when we prioritize short-term emotional reactions over long-term mathematical realities. Fear, greed, and the desire for immediate gratification are erratic. Financial math is cold, structured, and entirely predictable if you follow the rules. To build a portfolio that actually works, you have to replace those emotional reactions with a strict, step-by-step architectural plan. Mastering dividend income means discarding the illusions. Once you commit strictly to the math, you are finally ready to execute a strategy that lasts. You understand the math behind dividends, you know how they work, and you know the 5 biggest mistakes to avoid. Now we need a prioritized step-by-step plan to actually execute. Step 1 starts with a broad market index fund. An index fund is a low-cost investment that tracks the performance of the overall stock market. In diversification, you own dozens of companies at once in a single package. Half of them pulse gold to represent dividend-paying companies, while the green shapes represent broader long-term growth. Of course, this foundation can lose value in the short term. It dips, recovers, and stabilizes. Accepting that short-term volatility is necessary. You need this broad, stable base established first, before you start layering on a more complex, dividend-specific portfolio. Step 2 is automating your monthly contributions. The exact dollar amount matters far less than the consistency of the habit. Even $50 or $100 a month adds up over time. By setting up an automatic transfer, you remove the internal debate. Money goes in every single month, no decisions required, and no emotional hesitation. Step 3 is activating a DRIP, or a dividend reinvestment plan. A DRIP is a brokerage setting that automatically takes the cash dividends you receive and uses them to buy more of the exact same investment. Look at this model to see the mechanics in action. Instead of cash sitting idle in your account, a dividend payout emerges and is instantly converted into a fractional share, which is then plugged right back into your existing portfolio. Those new fractional shares then generate their own dividends, which buy even more shares. Over time, this creates a continuous compounding loop that accelerates and steadily expands your total holdings. With those 2 steps complete, your system is fully autonomous. Your portfolio is now growing from 2 distinct directions at the exact same time: your manual deposits and mathematical compounding. Step 4 focuses on your personal savings rate. If you want to build a larger dividend portfolio faster, chasing higher yields usually isn't the answer. Investing more capital is. Look closely at your monthly spending. Find exactly one subscription or recurring expense you do not truly need, cancel it, and redirect that exact amount into your automated investment transfer. That might seem trivial, but an extra $10 or $20 a month injected into a compounding loop produces a massive mathematical difference over the course of decades. Step 5 happens once your portfolio reaches a meaningful, comfortable base. At that point, you can start adding targeted, dividend-focused funds alongside your original broad market fund. This visualization compares the 2 structures. On the left is your broad market foundation, and on the right is the new targeted fund holding companies with long track records of growing payouts. Both distinct structures feed directly into a single unified total income stream. By holding both, you build a balanced, dual-engine wealth vehicle. You capture the broad market's growth while heavily boosting your overall yield. Step 6 is managing your psychology by setting small, sequential milestone targets for your monthly dividend income. This progression chart maps out exactly how to do it. Your first target is $10 a month in dividends, then $25, then $50, then $100 a month. If you fixate on $1,000 a month right from the start, you will get discouraged by how far away it seems. Hitting these smaller milestones provides tangible proof that the underlying math is actually working. Step 7 restricts how often you look at that math. You should review your portfolio exactly once every 3 months. During that quarterly review, you are checking exactly 3 metrics: your total return, your current dividend income, and whether your automatic bank transfers are still operating on schedule. Checking your account every day or every week triggers emotional reactions. It leads to unnecessary tinkering that quietly degrades your returns over the long haul. $1,000 a month in dividends is entirely achievable, but it is not a shortcut and it is not a hack. It is the mathematical outcome of consistent investing, patient compounding, and a plan built on real numbers instead of social media hype. Start exactly where you are today. Invest whatever amount you can afford and let the automated system do its work. If this helped you see the math behind dividends, hit like so more people can find it. Comment dividend goal below and subscribe.